The Philadelphia Semiconductor Index finished down 10% for the week ending July 17, 2026. The Korean Semiconductor Index is down 25% from its June peak. Taiwanese equities have entered correction territory. Chip stocks led a global sell-off that started in Asia and spread across every major market. Netflix plunged on weak guidance. The streaming giant that was supposed to be AI-proof. Renewed Middle East escalation also weighed on sentiment as the US and Iran have intensified attacks, driving oil prices 4% higher today, with WTI at $81 per barrel. The energy sector was the only one higher, while technology and communication services led to the downside. This is the most significant single sector market event of 2026, and almost all of the coverage is missing the most important part of the story. The price charts tell you what happened. They don't tell you why it matters beyond the portfolios of people who own semiconductor stocks. Today, I'm going to tell you the full story of the July 2026 semiconductor sell-off, what's driving it, what it means for the AI infrastructure boom we've been documenting since video 33, and why the geopolitical dimension of this sell-off is the part that should genuinely concern every American regardless of whether they own a single semiconductor stock. I'm pairing this with the most important book written about chips and global power, Chip War, by Chris Miller, the definitive, Pulitzer Prize-winning account of how semiconductors became the most strategically important technology in human history, and why a chip crash is never just a stock market event. Welcome to Earnings Per Page. Honest finance, no hype. Hit subscribe. Let's get into it. Part 1. What exactly just happened? The precise numbers. Let me be specific about the damage. The Philadelphia Semiconductor Index, the SOX, which tracks the world's major semiconductor companies, fell 10% in a single week? That's not a correction. That's a crash. By comparison, the S&P 500 lost 17.5% in all of 2022, its worst year since 1937. A 10% weekly drop in any major index is a significant event. In Asia, the damage is deeper. The Korean Semiconductor Index is down 25% from its June peak. Samsung Electronics and SK Hynix, which together dominate global memory chip production, have seen extraordinary declines. Taiwanese equities have entered correction territory, and Taiwan's equity market is essentially a proxy for TSMC, which manufactures roughly 90% of the world's most advanced chips. This isn't just a US story, it's a global event. The semiconductor supply chain spans the United States, the Netherlands, Japan, South Korea, and Taiwan. And this week, every single node of that chain was under financial pressure simultaneously. Part 2. What's driving the sell-off? 3 separate forces. The semiconductor sell-off isn't driven by one factor. 3 separate forces are colliding simultaneously. Force 1. AI spending timing uncertainty. We covered this in videos 33 and 41. IBM's 24% single-day collapse after its Q2 earnings miss was the first visible crack in the AI infrastructure timeline. The pattern is now spreading. Ericsson's CEO told CNBC that the firm's woes primarily stem from a flattish global market for 5G infrastructure and rising semiconductor costs driven by a shortage of chip components. The AI boom is requiring enormous quantities of advanced chips, but the deployment cycle is proving uneven. Some companies are spending exactly as projected. Others are shifting capital expenditure timing in ways that create unpredictable demand fluctuations for semiconductor makers. When demand timing is uncertain, semiconductor stocks, which trade on future earnings projections, reprice rapidly downward. Force 2. Geopolitical escalation and Iran. Crude prices perked up after U.S. Central Command said the U.S. launched more attacks against Iran. The strikes are designed to further degrade military capabilities Iranian forces have used to attack commercial shipping in the Strait of Hormuz. The Iran conflict creates 2 specific pressures on semiconductors. First, rising oil prices raise manufacturing costs for energy-intensive chip fabrication. TSMC's fabs in Taiwan consume enormous quantities of electricity, and energy costs flow directly into margins. Second, geopolitical uncertainty in the Middle East raises the risk premium on global technology supply chains. Investors reduce exposure to volatile sectors when geopolitical risk is elevated. Force 3. The rotation out of momentum. The Philadelphia Semiconductor Index finished down 10% for the week, partly because semiconductor stocks had run dramatically ahead of fundamentals in the first half of 2026. We covered this in video 38. The index fund paradox, where passive money mechanically buys the largest names regardless of price. Semiconductor stocks were the largest beneficiaries of AI momentum buying. When momentum reverses, for any reason, the same mechanical flows work in reverse. The ETFs that bought semiconductor stocks on the way up now see outflows that force selling regardless of individual company fundamentals. Part 3. What chip war tells us about why this matters beyond stock prices. Chris Miller's Chip War, published in 2022 and winner of the Financial Times and McKinsey Business Book of the Year, is the most comprehensive account ever written of how semiconductors became the defining technology of the 21st century. Miller's central argument is this: control over semiconductor production is the most important form of technological and economic power in the modern world, more important than oil, more important than financial capital, more important than military hardware, because modern military hardware is itself dependent on semiconductors. Here's what Miller documents that makes today's sell-off genuinely alarming beyond the price charts. The global semiconductor supply chain has one critical choke point. TSMC in Taiwan manufactures roughly 90% of the world's most advanced chips, the kind needed for AI computing, advanced military systems, and high-end consumer electronics. There is no meaningful alternative. Intel tried to compete with TSMC's advanced node manufacturing and spent over $100 billion in capital expenditures over several years while still lagging. Samsung's advanced node yields have consistently trailed TSMC's. ASML in the Netherlands is the only company in the world that makes the extreme ultraviolet lithography machines that allow chips to be manufactured at the scales TSMC operates at. There are fewer than 60 of these machines in existence globally. Each takes years to build. This supply chain is both miraculous in its precision and terrifying in its fragility. Miller documents how the 2020-2021 chip shortage, triggered by a combination of COVID demand surge and production disruption, cost the global economy over $500 billion in lost automotive and consumer electronics production. A more serious disruption, particularly any military conflict in the Taiwan Strait, would be orders of magnitude more severe. Now connect this to the July 2026 sell-off. The chip stocks falling this week represent companies that are nodes in the most strategically critical supply chain in the world. When Taiwan's equity markets enter correction territory, while US-Iran tensions are escalating and oil is at $81, these are not independent events. They are connected through the global risk premium that institutional investors apply to any complex, interdependent supply chain when geopolitical uncertainty rises. Part 4. The Netflix angle and what it tells us about the AI revenue timeline. Netflix plunged on weak guidance this week. Netflix is directly relevant to the semiconductor story because Netflix represents the application layer of the AI ecosystem. The consumer facing products that are supposed to generate the revenue that justifies the $700 billion in AI infrastructure spending we documented in video 33. Netflix has been heavily investing in AI for content recommendations, for content generation assistance, for compression technology that reduces bandwidth costs. The company was supposed to be one of the clearest beneficiaries of AI tools, lowering content production costs. If Netflix is delivering weak guidance despite being a major AI application layer company, it raises the same question that IBM's earnings miss raised in video 41. The AI infrastructure boom is generating enormous capital expenditure. But where is the revenue? The application layer companies that should be monetizing AI capabilities are delivering mixed or disappointing results. This is not a crisis. It is a timing issue. Technology deployments take longer to generate revenue than infrastructure build-outs take to generate costs. But it creates a specific investment risk. The companies that are spending on AI infrastructure are spending now. Their capex is immediate. The revenue from AI applications is proving delayed. This gap between the cost curve and the revenue curve is part of what's creating the semiconductor sell-off. Part 5. The S&P 500 earnings context and what it means for the rest of earnings season. When looking at full-year projections, S&P 500 EPS are anticipated to rise 22.9% in 2026 and then 18.2% in 2027. This comes as the S&P 500's forward price to earnings ratio was at 21.3 times on June 30, a 7.5% premium relative to its 10-year average. Entering this Q2 EPS reporting period with such high growth expectations may prove challenging. especially if forward guidance is limited by inflationary uncertainties. This is the exact environment Chris Miller warns about in a different context: an ecosystem where everyone assumes the technology will work on schedule, deliver the projected returns on timeline, and that the supply chain will remain undisrupted. When any of those assumptions proves optimistic, even modestly, the financial consequences are amplified by the gap between expectation and reality. The S&P 500 23 times forward earnings is priced for 20.9% EPS growth in 2026. IBM and Netflix have already shown that AI-driven guidance disappointments are real. The semiconductor sell-off this week suggests the market is repricing the AI timeline assumption. This doesn't mean the growth won't come. Miller's book is ultimately optimistic about semiconductor technology's long-term trajectory. It means the price you pay for that growth matters. And 21.3 times forward earnings is paying up significantly for a growth rate that's already showing early signs of being uneven. Part 6. The China angle, the most underreported part of this week's story. China exports in June rose 27% from a year earlier in US dollar terms, the strongest since October 2021, customs data showed Tuesday. Imports grew 36% in June, the largest jump since June 2021. This number is extraordinary. China's export growth at 27%, its strongest since October 2021, is happening simultaneously with the US tightening semiconductor export controls against China. This creates a specific and underreported tension. China cannot import America's most advanced chips under current export controls. China's domestic semiconductor industry, SMIC and others, is years behind TSMC's capabilities. But China's manufacturing exports, the products that use chips, are surging. How? Because China has been stockpiling chips acquired before the latest rounds of export controls, developing workarounds through third-country routing, and increasing production of less advanced chips domestically. Alibaba's Qwen AI model will be integrated into Apple Intelligence in China, state media reported. This is a significant development. Apple's AI services in China being powered by a Chinese AI model rather than Apple's own, and it represents exactly the kind of supply chain fragmentation that Miller documents throughout chip war. The technology ecosystem is splitting. US companies are building AI systems using TSMC chips and ASML machines. Chinese companies are building AI systems using domestically produced or stockpiled chips. The July 2026 semiconductor sell-off is partly a market expression of uncertainty about which ecosystem will prove more durable and productive over the next decade. Part 7. What to actually do. The honest practical section. Here's the investment framework that chip war's geopolitical insights and the current sell-off suggest for individual investors. First, understand that semiconductor stocks are inherently cyclical. Miller documents multiple boom and bust cycles across the history of the chip industry. The current sell-off is painful for holders of semiconductor ETFs, the SUEXCU individual names like NVIDIA, ASML, and TSMC. But it is a correction within a long-term growth trajectory that Miller documents as genuinely structural. AI demand for advanced chips is real. The question is timeline, not destination. Second, the shovel sellers from Video 33 are more durable than the momentum plays. TSMC manufactures chips for everyone. Apple, NVIDIA, AMD, Qualcomm. ASML sells the only machines that allow advanced chip manufacturing. These companies have genuine moats that don't depend on any single AI application succeeding. Their stocks falling in a broad semiconductor sell-off creates potential value opportunities. If you're doing the Buffett framework analysis from Video 42, not just reacting to price momentum. Third, the geopolitical risk is real and not fully priced. Miller's most important warning is that the concentration of advanced chip production in Taiwan creates a systemic risk that financial models consistently underestimate. This doesn't mean sell everything Taiwan related. It means maintain awareness that geopolitical disruption to the Taiwan Strait would have consequences far beyond stock prices, and that some portfolio hedging against that scenario is rational, not paranoid. Fourth, watch China's chip trajectory closely. The Apple Alibaba Qwen integration is a small but specific data point suggesting that the Chinese AI ecosystem is developing faster than many Western analysts expected. Companies with significant China exposure face a specific risk, being cut out of the Chinese AI market by domestic alternatives. Final verdict on chip war. Should you read it to understand the July 2026 semiconductor sell-off? Absolutely yes. And it's one of the few books that will make you genuinely smarter about geopolitics, technology, and investment risk simultaneously. Miller manages to make the history of semiconductor manufacturing genuinely gripping, tracing the arc from Texas Instruments in the 1950s to TSMC's dominance today. My rating, 10 out of 10. One of the most important finance and technology books of the decade. The honest bottom line for July 19th, 2026. The semiconductor sell-off isn't just a stock market event. It's the financial markets expressing uncertainty about the AI revenue timeline, geopolitical risk from US-Iran tensions, and the structural fragility of a supply chain that runs through Taiwan. The Philadelphia Semiconductor Index down 10% in 1 week is a meaningful correction, not a crisis, but a meaningful reminder that the AI infrastructure boom from video 33 was never going to be a straight line up. If this gave you a more complete picture of what's happening in the chip market, subscribe to Earnings Per Page. Drop a comment with whether you think the semiconductor sell-off is a buying opportunity or an early warning sign. See you in the next one.